The old bait and switch. It's a tale as old as time. High early cash value policies always look great on the front, but we need to understand what's happening in the long term on the back end of your supposed infinite banking policy. Hey guys, it's Erika Neil, and today we are going to get into some real money talk about the difference between high early cash value policies and true long-term compound building infinite banking policies. So this is a situation I had to make a video on it because a client of mine, a now client, came to me with a proposal she got from a different company, and it was designed to be a heavy upfront early cash value, which is great. We all want more cash up front. However, we have to acknowledge that there's no such thing as free money. Have you ever looked at something and been like, this is too good to be true? If it walks like a duck and talks like a duck, it's probably a duck. So we need to figure out if it's looking too good to be true, maybe it is, right? So if we're getting a lot of cash up front, no company has a magic pill. No company is really doing things much differently than others, especially if you stay within the top five A-rated, mutually owned, like solid companies. Nobody has a silver bullet, okay? There's no free money. If you're getting money up front, it has to come from somewhere else. So we're going to do a comparison and actually go through a breakdown of the difference in policies that have high early cash value and what the sacrifice is compared to a traditional IBC policy and how I would design it and look at what that long-term implication would be from there. Now, if you don't know exactly what an infinite banking is, be sure you go back and watch some of my other videos that would go into a little bit more detail. But essentially, infinite banking is taking a specially designed cash value life policy where instead of just paying your premium for your policy, you actually dump extra cash into the policy and treat it like your own private bank. And that cash can be used for anything and everything. You're the banker, so you make the rules. So we're going to be looking at these policies that are designed to hold cash. It's not just about the death benefit, it's about holding equity, holding cash inside of these policies, and then being able to use that cash and go deploy it elsewhere. Again, we have more detail on that strategy specifically in some of these other videos. Today, we're going to be looking at the design and really making sure we understand the difference between high early upfront cash value and long-term wealth building. Let's get into it. Okay, so in this particular setup, I wanted to go through it on a kind of on a 5-year breakdown, just because most policies have their illustrations broken down into 5 years anyway. So why not be consistent? And that way we can do an apples to apples comparison. Okay. So this is the high early cash value. I just did a screenshot. Obviously, I had her permission, but I did a screenshot of it so that we can use this information. Now, we're going to be looking at the net cash value. So this particular company shows the net cash value, and it's also showing what the annual increase is in that cash value every year. So that's going to come in handy a little bit later. So year one, what she's putting in, her net outlay for year one is she put $94,000 in year one. If she were to put in $94,000 in year one, she would have access to 87,582. So 87,500 of the 94 that she put in would be immediately accessible. That's great. Okay, that's wonderful. Now, what we start to see is after year one, she goes down. She's like, hey, I have a lump sum. I want to put a little bit extra cash in year one and then back it down. So now she's going from funding 94 to putting in 50,000 per year. Now, I'm going to pause for just a minute because this is an example, just because this is something that happened with a real client and somebody that's really doing this. And we're using these numbers because this is a real illustration. Now, for you, just kind of keep in the mind that everybody has a different set of zeros, right? So the strategy is what it is. It could be somebody that's doing 5,000 a year, someone that's doing 5 million a year, right? The number of zeros doesn't matter. The strategy and the principles of this are all going to be the same. So don't worry, if your number is this, great. If it's something else, that's great too. We're using this as an example. So I just wanted to bring up, what you're funding and what your level of, commitment is to these policies is completely up to you. Now, back into this in year two, if she were to put in 50, she would now have a combined 139. So essentially, year two, she puts in 50 and it goes by 51.9, almost 52. Again, this is looking great. Year three, she puts in 50, goes up to 193, almost 54,000 of increase in that year. Year 4, 246, year 5, 301. So it kind of has an anomaly here in year 4. That's not uncommon. It does go down a little bit. And then as we get into year 5, at the end of year 5, she's 50 years old and she has put in 294 and has access to 301. So she's put in 294, she has access to 301, and at this point, she's getting what I like to call the multiplier, where it's not, this is where people are like, well, how much is this going to cost me? Well, in this scenario, let's just use this. If you put in $50,000 into something and it spits out 54.6, how much did it cost you in that year? Right at that point, right? This is where the banking aspect comes in, okay? Where you're able to use more money from your cash value than what you contributed, all right? Now, again, this snapshot in the first 5 years looks fantastic on these high early cash value policies. Now, before we look at the infinite banking policy and the difference between the first 5 years, please make sure you remember to hit that subscribe button, share, like, ring the bell, all of the things that you need to do to make sure that you are up to date on all of the upcoming videos that we have to offer. This is a more strategically designed IBC policy, okay? Exact same outlay where she puts in 94. We are going to look at the non-guaranteed scale because it does include the dividends. This company in particular, they've paid dividends every year for over 120 years. So they're reliable. The point is, in year 1, if she puts in 94 into this one, she's going to have access to 76. Again, that's a great number. She has access to a majority of the money that she's putting into this policy. If we compare that, though, over here, I mean, we're at like a $10,000 difference in year 1. That kind of makes people tense up a little bit. And I get it, but let's keep going. Now, when we move into year 2, she puts in that 50 and we start to see, oh, well, she puts in 50 and it's growing by, what is that? 48.2. So not quite the full 50, but 48.2. Now, what's happening here? In fact, what's happening in both year 1? Let's address this. Year 1 in the IBC policy and year 1 in the high early cash value policy. There is less in cash value than what's being contributed. What is happening in year 1 is, I use this analogy. I work with a lot of real estate investors and business owners, and the best analogy I've come up with is this is like the acquisition cost of purchasing an asset. If you buy a business, if you buy a property, if you buy a mutual fund, right? Anything we buy has an acquisition cost to it, right? It's not, there's no such thing as free. Business and real estate, they all have closing costs. There's an acquisition cost to purchasing the asset. In this particular policy design, she puts in 94, has access to 87, and her death benefit is 2.4. So what this company is saying is, hey, lady, you put this money in and that's great. We're going to give you access to 87 of it, but we do have to set a little bit of it to the side because there's a $2.4 million death benefit. Lover wanted to live a long, healthy life. But if she walks outside and gets hit by a bus, this company's on the hook for 2.4 million. Okay. That means they have to set a little bit of the money that she puts in to the side to go into that risk bucket to make sure that they've got all of their actuarial costs accounted for. Okay. This is a life insurance policy, so there is a death benefit aspect. Okay. So that's why in year 1, we see there's a difference between what's contributed and what the cash value is. Same thing on this one. Now, in this particular conversation with her, death benefit was not huge. So I intentionally did not increase her death benefit to that amount. She said, hey, that's not, I don't need 2.4. That's not something that I'm really going for. If she did want that, I would have increased that, but I didn't. Okay. So that's why there's a difference on the death benefit. But the same principle applies with the cash value. There is a death benefit here. Okay. So when she puts in 94, she has access to 76. So that is going to pay for the cost of purchasing this asset, purchasing this policy. Okay. So that's what's going on in year 1. Now, what happens is in year 2 and even in year 3, she puts in 50, it grows by 48. She puts in 50 in year 3, grows by 49 too. So she's almost dollar for dollar in year three. Okay. What's happening here is most of the cost is absorbed in year one, and then there's a little bit of cost that's being accounted for in year two and three, but she still has a large access to her cash in this design. Year four, she puts in 50, and now we start to see, okay, she's putting in 50 now, it's growing by 52. So at this point, she has accounted for the cost of getting this policy started. She's overcome what we call the acquisition cost. And now she starts to get that multiplier, right? Where she puts in 50 and her cash value is going to grow by 52. All right. Now, year five, same thing. She puts in 50. And we see that policy grow by, what is that, 55. Awesome. So the first 5 years, when we look at year four and year five and we compare it to the high early cash value policy, I mean, by year five, it's caught up. By year five, it's caught up as far as, let me say this, as far as what the net cash value increase is. The net cash value increase, how much it's increasing in the first 4 years is higher in the high early cash value policy. Why do you think they call it high early cash value, right? It's early, it's getting that high return in those early years. That's great. At the total amount at the end of year five is 301 compared to the traditional IBC policy is 280. So we see the discrepancy here. We had some cost to overcome on the IBC side. Now we've done that. We are a little bit behind in year five. Let's go to the next 5 years. So we just looked at years 1 through 5. Obviously, high early cash value outperformed, right? It's staying true to its name. Let's look at the next 5 years. In the next 5 years, here's what we start to see. Year six, she's putting in 50, and her cash value is increasing by 38. Wait a minute. Wait a minute. Why? If I'm putting in 50, and the year before I was getting out 55, why am I only getting 38? Same thing in year seven. She puts in 50, it grows by 39, 9, almost 40. Year 50, 41. Year 9, 43. Year 10, 44. So every year in this 6 through 10 range, she's putting in 50. And is it growing? Absolutely. Is it growing? And is she getting that multiplier? And is she still seeing that same bang for her buck in this next bracket of time that she saw in the first 5 years? Obviously, no. What happened? Well, y'all remember when I first started, I said there's no such thing as free money. We saw on that IBC policy, there was a little bit more cost up front. Okay. There's obviously, right? We acknowledge the first 5 years, the first 1, 2, and 3 years, we saw that drag a little bit more than what we're seeing here. Does this company have some magic pill? Do they have, magical actuaries? No, 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 no. All they did was they moved that cost from the first 5 years and they moved it here. It's going to be paid. There's no free money. So in the next 5 years, in this second bracket here, years 6 through 10, she's putting in 50. She's only getting out. Now she still has this cash here, but the increase, and again, the bang that she's getting, the bang for her buck that she's getting is less in this 6 through 10 year. Let's compare that to an IBC policy. So here we are, year 6 through 10. Year 6, she puts in 50. And this company is not as nice, and they don't give us the annual increase like they do on that first one. She puts in 50, and we see the cash goes from 280 to 338. So that's about $58,000. So she's putting in 50, she's getting 58. In year 7, she goes from 338 to 399. So in year 7, she's putting in 50 and getting out 61. In year 8, she puts in 50 and it grows to 463. So she's getting $64,000 out at this point. Year 9 puts in 50. Year 10 puts in 50 and it's growing by, what is that, 68 at that point? So again, there's no such thing as free money. We had some cost on the upfront, of this policy, obviously here. Now she has 598 available, total 598 available at the end of 10 years. And at this point, she's putting in 50 and getting out, what do we say, 68? If we compare that to this high early cash value, not only does she have less cash because this one has 598.9 and this one has 509. So we're about $90,000 difference total. Same funding, mind you, all the same money being put in. She's $100,000. Let me back up, about $90,000 less in this policy now. And the bang for her buck, she's actually taking steps backwards. This policy is costing her money at this point because she is not getting out more than what she puts in. Compared to a traditional or, the design that I like to do for clients, designed on this one, she has more cash value and she is getting more bang for her buck because she's putting in 50, taking out 64. So all of that to say, all they did was flip it. Okay, that's all that happened. And this gives, when we look at these high early cash value policies, yeah, this looks great and wonderful, but again, that's the bait and switch. What are you giving up? If you're getting that much money here, where is it coming from? Okay, let's look at the next 5 years. So here she's still in year 11, still not getting her bang from her buck. Now in year 12, she starts to see that she is back on track. Those costs have now been absorbed in the policy, and she starts to see that she's getting more than what she's contributed with that funding. So at the end of year 15, she has, and oh, this is something I hadn't even looked at. So one more thing, I want to back up. So again, she's put in 544, 509. She hasn't even broken even in her cash value. Here, she's put in 544. She's more than broken even. In fact, I think she broke even, like usually it's around like year 6 or, 7 maybe. So she hasn't even broken even after 10 years. That's insane to me. That's absolutely asinine. So here in year 15, she's contributed 794. She is starting to get more bang for her buck, which is good. We're starting to see her money work harder, but she still hasn't broken even. In 15 years, starting to make me mad now. Let's come over here. 15 years. Now, here's what I did for her. Again, I structured this to be a little bit different. For her, she wanted to fund at that level for 10 years. And now she said, after when I'm getting into my 50s and like 56, she's like, I want to back down to not funding as much. And two things. One, absolutely not a big deal. We can back it down. That's how we have it designed. Number two, if she gets to this point right here, if she gets to this point and she says, hey, Erika, I do actually want to put more money in. Great. I have it set up that she could put in the 50 if she wants to. But this is what she said she wanted to do. She's like, I don't want to be stuck paying $50,000 a year every year for the rest of my life. Girl, I got you. We didn't do that. We set it up the way that she wanted it. So I did this intentionally though, because here we are in year 11. She's putting in 15 and she is gaining 41. She's putting in 15, gaining 41. Let's look at the high early cash value. In year 11, she's putting in 50 and getting 48. She's getting almost more bang for her buck, almost the same amount of bang for her buck on 15 grand as what this cash value policy here are doing 50. Okay. Now, if we look at, again, we're just gonna, y'all can see these numbers. At the end, she has 780, almost 781 in the high early cash value. Versus here, even though she's only been funding 15 for the last 5 years, she still has 821, almost 822. So let's just keep going. Now she's 65. Holy crap, she's finally broken even. Finally, she's put in $1 million at age 65. She finally has 1.1. Okay, thanks, guys. And we're still seeing, the good news is that she is continuing to see that increase on her money. Okay. Coming over here at 65. She does have 1.1 million. She has the same 1.1 million. Here's the difference. She's only contributed 694. So she's only contributed 694 and has 1.1 million versus having contributed over $1 million and still only having 1.1. And let's just keep going. Scrolling down here, age 70, we're seeing 83, 85. So at age 70, if she's putting in 50, she's getting 93. Let's look at the IBC policy. At age 70, if she puts in 13, which, oh yeah, it drops again. Again, I'm not going to go into why, there's a reason, but now she's only paying almost 14. And let's do the math. It goes from 1.38 to 1.456. So she's getting 76 off of a $14,000. Now, let me pause for a minute. Does this mean that her $14,000 is earning 76? No, 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 no. That's not what I'm saying. I'm using that as an example because it's easy to compare with the way that the other policy is laid out. What's actually happening is it is the guaranteed interest and dividends inside of this cash value that's rolling over and consistently compounding. Okay. She is at this point putting in 14 and she's going to be able to access that 76, right? Because that's what the policy is performing and that's what it's doing. So I don't have so that's as much as I had on here. But here we are at age 75. She's put in almost 1.3, and she has access to 1.5, almost 1.6. Versus here, age 70. So this amount is 69,650. Add that to what she contributed here, 694. So she has put in at this point 763,650. And she has 1.4, almost 1.5. Versus here, she's put in 1.3 and has 1.5, almost 1.6. So imagine if she did decide that she wanted to put in that 50 here. Again, could she do that? Yes. She told me she didn't want to do that, so I designed it this way. I designed it the way that she wanted it. So again, and then this just continues to go. In fact, after age 75, this is completely paid off. So she's putting in $0 and it's going to continue to just multiply and grow. So a couple of things. I know the main question that I'm going to get is, do I have to fund this forever? Absolutely not. In fact, this policy right here, I want to say it was paid up after 4 or 5 years where she could just stop funding and just fund zero for the rest of her life. That's totally possible. The challenge to that is, even right here, if she's putting in 50 and it's growing by 61, I mean, why not, right? Do you have to? No. Are you going to want to? Yeah. So that's my first thought. The other question and the other point to bring up is, keep in mind when people are looking at this, because I know we're going to lose sight of what's really important here, but all of this cash value and everything that's going on in this column right here is in addition to whatever she's invested in out here. Because we're using non-recognized loans, meaning she can take this money and go invest it while allowing it to continue to grow. For example, right here, she can take out $300K, let it go invest and do what it's doing, and she's still going to see this growth and compounding occur. So this is not on its own. It's not meant to be on its own. It's meant to be in addition to what she's investing in at the same time. So I just kind of wanted to bring that up for people who weren't familiar with that. Does that mean that high early cash values are bad? No. So again, there's no good or bad tool, but we just need to have the full scope of what we're getting into. I don't want people getting feeling like they got a bait and switch. I don't want people to get into a situation where, good Lord, I mean, 10 years in, you're putting in 50 and you're not even getting out what you're putting in. That's just not helpful. Especially this late in the policy. Yes, do we have the cost built in on this IBC policy? Absolutely. But the difference is we get it out of the way early. We get it out of the way early because what is the most valuable resource you have? Time. If we can get the cost out of the way early, then we don't have a drag on the policy later on when you actually have the most opportunity for growth, right? Because are you going to get more growth on 76 or on 338? Right? Same thing here. She got the growth on 87. She's not getting as much growth on the 339. Okay. So because of the way that they structured the cost, it's actually creating a longer drag in the long term. So when we look at this, it's just important to remember there's no free money. Where is that coming from? And making sure you look at the long-term implications. Now, as always, I like to point out there's no good or bad tool, but if you cut a piece of wood in half with a hammer, we can't get mad at the hammer and say, oh, this sucks. It's being used incorrectly. Same thing with infinite banking policies. Yes, these policies do have a cost. All policies have a cost. Everything we do has a cost. I may not go to Starbucks and get my coffee. I'm drinking my coffee right here from home, but guess what? It still has a cost. So it's just important to make sure that we understand what that cost is. And is it something we're willing to deal with? Is it something that acquisition fee or that acquisition cost is worth the asset that you're getting? That's the question. So the other question that we need to think about is when you're looking at the high early cash value, when you get that money in the first 5 years, are you a get rich quick kind of person, or are you a long-term wealth building kind of person? Who is this really for? And really, that's what you have to ask yourself. Do you want to get quick and easy access to cash, or do you want to build long-term sustainable growth, sustainable wealth that's going to multiply and get better and better and better for you every single year moving forward? So be sure to join us next time. Make sure you hit that subscribe button, like, and share this video with as many people as you can. And until then, keep it real.